We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Crescat Portfolio Manager Tavi Costa. How are you today, Tavi?
Hi, Tom. Thanks for having me. I'm great. How are you?
I'm excellent, and it's great to have you back. It's always nice to see you and to chat with you. So your pinned tweet right now says that the Fed is trapped. So let's go over some of the numbers and what happened in 2020 and why 2021 could actually be worse for fiscal spending.
Look, it all starts with what happened at about $4.4 trillion of debt issuance that we saw in 2020, mostly due to the pandemic. But I think it's also something we were already working towards, which was, basically record low unemployment rates prior to the pandemic problems. But the fiscal deficit was already extreme even prior to the whole situation. So that certainly accelerated the problem. And the Federal Reserve was buying basically 50 to 60% of all those treasuries being issued. Initially, most of those issuances happened in the very short-term maturities, especially the T-bills. And then later on, we're seeing this increase in issuances now happening in longer duration treasuries. To be specific now in 2021, what is even more interesting to me is that the pace of the Federal Reserve purchases of treasuries have actually gone, at least 40% lower than what it was in average per month in 2020, while treasury issuances are actually increasing significantly. And so it brings back the question of, can we even taper in this scenario? And so it's a tough place because the Federal Reserve has to continue to suppress interest rates in order to allow the government to not only invest or spend as much as it has been spending, but also it needs to suppress interest rates in order to justify the record multiples we see in equity markets and corporate bond markets and so forth. And so that's really the trap part. And by creating this environment where we're seeing fiscal and monetary policy as such an extreme, what we're seeing is that investors are starting to buy into tangible assets to protect against the dilution of money and therefore creating inflationary forces in the system. We can get into that as well, which I think it's a big part of how we are positioned today by buying a lot of tangible assets, commodities, especially.
Absolutely. I'd like to get there. But with the Fed buying 54% of the total issuance, like you touched on, does this represent a drop in foreign interest in these treasuries?
Yes, that's the other part of the other angle that it's important to stress, which is the fact that we're seeing a reduction of participation by foreign investors in this market of buying treasuries. We've had a few foreign investors increasing their percentage of ownership recently, but certainly not on a long-term basis. We're seeing a downward trend in that ownership number, and so it creates the reason why the trapped name that we refer to in terms of the Federal Reserve is because of this situation where they have to be the buyers of last resort at the end of the day. And so how do you do that at the same time as you have the economy running extremely hot with economic activity at levels we haven't seen in a long time? And again, this is not a situation where the economy is just doing significantly better organically. This is just because we are relocating a lot of the macro imbalances out of the private sector and putting on all the issues on the public sector. And so the government is the one really increasing its amount of debt and leverage in the system, while especially the private sector and households have effectually improved in terms of their balance sheets and their net worth and so forth. And that's also happening in the bottom 50%. So we saw the largest wealth transfer from the government to the people in history. And so those inflationary forces are picking up. And yeah, the Federal Reserve could certainly tighten things and probably delay the inflationary issue. But I don't think it's in a position where it could do that. And so we're seeing yields move up in 2021. Recently, we saw that actually pausing significantly in the last few weeks or so. But I think if the Federal Reserve continues to suppress rates, which I think it's almost its primary mandate here, is to continue to reduce rates in order to allow the government to borrow money and spend at the levels we're seeing and continue this wealth transfer. It's very difficult to not see inflationary forces really entering the system in a large way. And I'm not talking about transitory problems. I'm talking about something more long-standing, which I think is the case that we're entering right now.
It's very interesting, Tavi, as you're mentioning the wealth transfer from the Fed. All of this is coming at a time when net federal receipts are rolling over. So is this why they're instituting higher taxes, as we saw capital gains were raised last week?
Yes, I mean, there's no way around this. If you think about it, who ends up paying for all this mass is the taxpayer. We've seen this throughout history. If you look at marginal tax rate relative to debt to GDP on the government side, you see clearly that when you have those large economic or geopolitical events, such as World War I, World War II, you saw debt increasing relative to GDP. And then immediately we saw an increase of tax rates as well, especially for the richer parts of the society. So expect that to happen as well, which I don't think is really factored in to a lot of Wall Street analysts in regards to valuation of equity markets and how some of the companies will be squeezed by that as well in terms of their earnings. And so we're seeing parts of that already. And the counter argument to that is that we saw other periods in history where we saw very high tax rates, but did not impact negatively the equity markets. And I think that the difference here is how overvalued, multiples across almost every fundamental factor is at all-time highs today. And I think that's a big difference from looking back in the 50s and 40s when equity markets were extremely cheap. So certainly not the case today. In our measurements, we see basically record highs among almost every single fundamental factor, and that's certainly going to be another issue. The inflationary force is also an important one because, as perhaps I've said this before, but when you look back, there were really 2 decades that we had real inflation in the system, and by that I'm looking at the 1910s and the 1970s. The 1940s, which some people like to look back as well, was actually a period of a lot of sporadic increases in inflation, but not throughout the whole decade. We saw especially consumer prices for the 1910s and 1970s staying above 6% for the entire decade on a median basis, on an annual number. And this is important because the performance of equity markets was basically up 1% on annualized terms during the entire decade. And so when you look at that relative to, especially in real terms, so performance was actually negative in real terms. And I think the big reason for that is that inflation is not, something incredibly positive for equity markets, especially where we are at the valuations that we are right now. So I am very cautious about risky assets in general, even though I think commodities, which did very well in the 1910s and the 1970s, have a very high probability of outperforming the equity markets significantly in the following 5 to 10 years.
Tavi, as you're mentioning the equity markets being at these, very peaky tops, you guys put out a ton of excellent charts. So you have one that says the Crescat versus equity market valuation model chart. So how do you calculate the data that's in that chart, and what is it showing right now?
Sure, it's different ways. First, we aggregate different types of metrics that we calculate at Crescat, and a lot of those are very usual fundamental metrics in terms of aggregate basis or median basis or average basis. And so we try to be fair with every metric and allow them to have an equal weighted basis of including different types of universes as well, not only large caps, but small caps and so forth. And by looking at all that from a historical percentile basis, you see clearly that we are at all-time highs today. I've seen other people doing similar research, but I think the difference with ours is that it's much more in-depth. And you can also see that some other folks tend to look at earnings and profitability, but forget that margins tend to look great at the peak of the cycle. And so what we're seeing today, in my opinion, in terms of valuations, it looks a lot more concerning in regards to where estimates are relative to how depressed earnings are presented today. So if you look at the estimates, we're expected to see increases in EPS for small caps and S&P and NASDAQ stocks of somewhere close to 40 to 30% from the prior peak. And so I think it's a little bit unrealistic. And what we saw in 2020 of this complete disconnect between the economy and the financial markets, we may see it again in 2021, but the other way around, where the economy is doing better, but the equity markets may not benefit from this environment. And so I think most of the positive surprise is priced in the markets already.
Tavi, what are some of the assets that are already starting to account for this massive currency creation?
Well, certainly what we saw initially in 2020 was the increase in gold and silver, and even Bitcoin did very well in that year. Silver was up 50%, even though production, especially due to the pandemic and other issues, that was my whole point, is that raw materials in 1919 during the Spanish flu, in our research shows that we saw, especially from the supply side, was incredibly constrained and created an increase in raw materials and especially commodity prices during that time. And we're seeing this again today. As an example, we saw CapEx falling apart for silver producers, gold producers, even though we were in an upward trend for prices in that year. We're seeing again this in 2021, but it shifted from those, especially the monetary assets, to more of the cyclical ones. So we are seeing especially energy stocks leading the way in terms of the S&P 500 sectors by far, which is something we haven't seen in a real long time. We're seeing the change of leadership in the market from tech companies to those more resource-based stocks, and I think that's likely to happen for much longer. We're seeing copper near all-time highs now, and basically agricultural commodities doing very well. So all of that seems to not be reflected in the CPI numbers at a 2.6% annualized number, while almost virtually everything you look at is up at least 10%, but masks, you can maybe claim that masks are down significantly in prices, but everything else is up drastically, and I think that's already having a large impact especially in the cost of living. So what's next from here, especially using the roadmap of the 1919 Spanish flu, is that we may see labor cost pressure now. That's what I think is the new thesis sort of emerging. And so like before, we saw a lot of union labors in protests. 1 out of 5 Americans in the labor force back then was actually in a strike. So I think that this is, as the cost of living begins to rise, there's a very high probability that we may see labor cost pressure, which is something we haven't seen, as you all know, for a real long time. Wages and salaries have been trending lower and lower for a real long time. So again, all of this is a result of the policies, as a result of the pandemic, as a result of a long-term trend in the resource bases of natural resource bases of especially difficulty of finding and the scarcity of finding unskilled and skilled labor in general in the space, and the underinvestments in commodities as a whole. And so this is all coming into a very important inflection point for inflation, in my view, where we may see a long-term trend of higher consumer prices starting to be triggered in 2021.
Tavi, I want to get to some of the employment things that you mentioned, but could some of this rise in raw products cost be due to the supply chain backups caused by COVID?
It certainly has to do with that. If you look at the Dallas manufacturing report that came out recently, there was also the ISM manufacturing. If you look at the commentaries from executives all over the country in different parts of the economy, manufacturing or not, what you find is clearly that there are a lot of disruptions, very similar to what happened in 1919. And so those disruptions are now being met with large demand, which is just a demand of the economy going back to normal. And so at the same time as we just saw the largest wealth transfer in history, which quickly comparing to what we saw coming out of the global financial crisis, when the net worth of the bottom 50%, not the top, the bottom 50%, declined by about 84%. And so this time around, we're seeing the largest increase in the net worth of the bottom 50% in history. And that has a lot to do with housing prices too, but also a lot of money in the sidelines of people saving a lot of money too. And so I think all of that is playing a big role along with the supply disruptions. And I have a feeling that this idea that a lot of it is all transitory is very wrong. I think it's a lot more permanent than a lot of people realize. It's difficult, especially Palisades is also in the space of mining and knows that it's very difficult to find good labor today in the mining space. And this is happening across all commodities or related businesses. And so I think this is a real issue, and the discouragement from especially unemployed folks through the policies we're seeing of the government of allowing people to stay at home and make a significant amount of money is not allowing the economy to get back to normal in terms of the capacity of industries in general. And so what we're seeing is that disruption may actually last a lot longer than the Federal Reserve and a lot of economists are thinking. And the funny thing about this is that meanwhile, a lot of economists are seeing this as an output gap issue as part of a deflationary spiral, which I think is completely off with what's going on. The reason is that especially those labor numbers are lagging. There are lagging indicators of the economy. So what's happening is quite the opposite. People are choosing not to return labor market. And so I think it's an issue and it may continue, and it may actually create what I said before. It's a labor cost may increase significantly and start squeezing the margins of companies. Again, this is all positive for commodities at the end of the day. That's the negative part, is that some folks may be having to pay higher prices for their costs, and margins are going to be in trouble. And profitability may finally get back to a stage where it becomes a priority for investors, which everyone has been looking at growth. No one really cares about profitability. I think that's about to change. We're entering a new regime. And I don't think that a lot of the leadership that we saw in the last 5 to 10 years in equity markets is really about a change.
There's some interesting examples of this, Tavi, that you've been talking about the employment figures. And some of our recent guests have mentioned that even McDonald's is paying people just to come in for an interview. So this really, is an indication that, as you're saying, these low-skilled laborers would rather stay at home to make more money than they could just to be having an entry-level job.
Yeah.
But Tavi, do you have any projections for coming inflation? How would you like to measure inflation? And can we look at your finished goods chart for an indication of where inflation is actually headed?
Sure, and that's all data that was surveyed by some of those, regardless if it is the Federal Reserve or other manufacturing numbers and reports that come out with those. And it's incredible the difference between the survey of where they think prices are relative to where the CPI and the government data is being reported. But it's difficult to calculate inflation. I'll tell you that. I mean, it's not an easy calculation, but you can clearly see that it's certainly not 2.6% on a year-over-year basis. It's much, much hotter than that. And matter of fact, if you look at what happens in terms of inflation is as it becomes a prevailing narrative among general people, where, in other words, people on the streets begin to talk about inflation, you start seeing investors hoarding, especially anything that can protect them against inflation. You're not seeing people buying Bitcoin because they want to use it to buy coffee with using Bitcoin. They're doing it because they're worried about the monetary system and what we're doing in terms of policies. And so that is just exacerbating this issue, in my view. And so as you begin to see investors hoarding those tangible assets, hard assets, anything that protects you against inflation, it actually drives the prices of commodities and those tangible assets to rise, and therefore the cost of living and consumer prices rise significantly too. So this is precisely what we're seeing. I think that inflation in the system is as I said, the CPI number is completely bogus. And that's not coming from a person who likes to talk about conspiracy thoughts and ideas of why the government's doing that. I think it's actually, if you believe in that, it's actually very positive, because clearly the government is trying to hide what's the real inflation in the system, and therefore their policies will act accordingly. And so I think that given that scenario and that situation, we are in a conundrum where inflationary pressure is rising and the government cannot do anything about it. I think that this wealth transfer that we're seeing is becoming also a mandate. How do you get away from giving people, from helicopter money policies? You really cannot stall this issue anymore. And so what we may see is a continuation of those policies at the same time as we're seeing shortage of goods and the economy going back to normal at the same moment, and prices are rising. And so it's clear to me that we are perhaps entering a long-term inflationary scenario here, which will have an impact on how assets may, in the dynamic of the macro environment, how assets may behave. I think it's a good time to look back in history and see how commodities did very well during periods of inflation running above average. And I think that we are about to see something like that. And therefore, investors are starting to realize this and starting to buy a lot of commodities. So oil looks incredibly cheap. Gold looks incredibly cheap. Silver is perhaps the cheapest metal on earth. Even copper looks cheap right now. And on top of it all, Tom, what we're seeing is the green agenda that doesn't allow a lot of companies, or it's making it more difficult to mine natural resources or to acquire those resources, obtain those resources from here in the U.S. and other places in the world. So this is really a problem that is much more aggregated with a lot of factors than one or two things. And so I think there's a big chance that inflation is coming in a larger way. And I don't think a lot of folks are ready for that yet.
Tavi, when you're saying there's a lot of these commodities, they're at all-time lows, do you adjust those for inflation, and that's what gives you that perspective of seeing that these things are incredibly undervalued right now?
Well, yes, and it's, you should look at commodities relative to something else, and not everything is at all-time lows. Copper prices obviously are much higher, and even gold prices are much higher. And if you look at silver and oil and things like that, and you even calculate that relative or adjusted for inflation, you see clearly that we're still at near all-time lows, especially relative to the monetary base or money supply, or even the equity markets, because everything works through a flow perspective of capital. So if large capital allocators are putting a lot of money in bonds and equity markets, what we may see is that at a time now where the S&P 500, if you look at earnings yields less than the CPI number, which is completely bogus, which means when you have negative real earnings yield in this environment, where I think it forces capital allocators to look for any asset that it has a likelihood of appreciating in price. And so I think where you come from there is to look for tangible assets that are really cheap and continue to be much more attractive than other risky assets at near record valuations, regardless if it is corporate bonds or treasuries or sovereign other sovereign treasury sovereign bonds across the globe, or regardless of our real estate. Everything else is expensive but commodities, in my view. And so we're very focused on trying to have a very diversified portfolio, but actually with a lot of focus on monetary metals, because I think that's where it's going to come down to at some point. And the beauty of silver is that it kind of plays both ways, in the industrial side, in the cyclical side, but also as a monetary metal too. So I'm extremely bullish on things like silver, and I think commodities will continue to do very well. So a lot of reasons for why this trend should continue.
Tavi, you mentioned a couple bubbles a moment ago there. Where do you think the most inflated bubbles are at this point? Or does this time really live up to the name of being the everything bubble?
Well, the Treasury market is very, U.S. Treasuries are overvalued, but I think the equity markets really are where the problem it really is, especially when you look at where we are in terms of the returns that we've had so far in the last decade on annualized terms throughout history. It doesn't tend to persist. What we see usually, especially when you're entering an inflationary environment. So I think that's probably the case here, where equity markets may not perform anywhere close to what most investors are expecting. And that's going to change the dynamic of of asset allocation for, again, large capital allocators, pension funds, insurance companies, and so forth. And where do you get that you're paying for the buck for the risk that you're taking and investing in those places? Tech companies with very extreme multiples, that is probably not likely to be consistent with the macro setup that we may see in the following years. So growth stocks may change, the leadership may change from where I think that a lot of the mining companies with very strong fundamental growth, completely different from the skepticism we've seen, especially throughout the last decades or so of capital bleeding in general, and very levered balance sheets. And things are changing in this industry, especially in the precious metals industry. And so we're seeing an improvement of fundamentally speaking, where a lot of those large producers are cashed up to do very well in this environment, while they're also offering a lot of growth. You look at the growth in free cash flow is somewhere close to 130%. You look at aggregate free cash flow is growing like we've never seen before for the entire industry. And so at a time when the whole mining space is worth 3 or 4 times less than a lot of the tech companies, single names, Apple is worth 4 times the size of the entire mining space. And you can say, well, Apple makes more money than the entire mining space in aggregate. Sure, as of today, if we get silver prices above $30 an ounce, the game is over. A lot of those companies are incredibly profitable here. I don't think that's a big push to get up from $26 an ounce back to above $30 or so an ounce for silver. And that's happening across almost every commodity. So a lot of those companies are becoming profitable while at a time when they have been cutting costs too. And so dilution of capital has changed this industry. They're now buying back securities, believe it or not, for the first time to a degree that we've never seen before, especially the top 20 miners in the precious metal space. So a lot of things to unpack, but I think this leadership of growth, the new growth stocks for the next 5 to 10 years are not going to be the tech companies, are going to be mostly the natural resource stocks, such as the precious metals companies. And so those are the big changes, the big, especially the big macro changes in this environment, especially from a trading and investing perspective, in my opinion.
How do you see the risk of having another dramatic crash in the stock market right now, Tavi? Are there any indicators that you're looking at that are signaling of this possibility?
That's a $1 trillion question, and it's a tough one to answer. But look, I think there are, even though I've been talking about inflation this entire interview, I think there's a very important deflationary forces happening on the other side. And mostly that's the reckoning of those highly speculative bubbles. If we have the equity market completely falling apart in the next 3 months or 6 months, that will cause deflationary forces in the economy. That's not inflationary. The problem with all this, in my opinion, though, and why it's different than what we saw back in the prior recessions, and is the involvement, the level of involvement of the government and the Federal Reserve. We may see a 15% decline in equity markets that might be accompanied by a massive amount of stimulus, just like what we saw in 2020. And this is where I think the investors are kind of catching on to that idea. And that's where I think that there is a very high probability that precious metals companies and commodity companies in general may actually start diverging from the equity market, where we may see the overall equity market having issues, but not so much in the commodity space, given the fact that this level of intervention may continue, may persist due to the imbalances that we have in the system. And so answer your question in terms of a crash. Look, as a fund, we are positioned. If something like that happens, we have a significant amount of shorts that will profit from that, especially in the tech space, relative to being long commodities. However, I have a feeling that if we see a 20 to 30% decline in the equity markets, we will immediately see a significant amount of money being created again through the Federal Reserve. And as we see this pattern continuing, at some point it will create inflation. A lot of folks are focusing too much on the part of the monetary dilution doesn't create inflation because it didn't happen during the global financial crisis and post that period. But I think this is a little bit different because we have really three important parts. The monetary dilution is happening at a time we've never seen before, along with the fiscal stimulus. We've seen the supply disruptions, which is something we did not see back then, which is not as transitory as most believe. And the third one is the net worth of individuals and the wealth transfer is happening at a time we've never seen before. And so the combination of the three factors that create inflation are really at all cylinders right now. And so I think that this is a very different setup than what we saw coming out of the global financial crisis.
Tavi, you were talking about having $30 silver. So when we look at that, what are the important levels that you're looking at, and what does the year ahead look like to you guys?
Look, we need to close on a quarterly basis. If you just draw a line from the peak of 2011 all the way to where we are now, it's incredible that this 26 level on silver is sort of a big deal. If it closes above that on a quarterly candle, it is considered a breakout from a multi-year trend. And as we all know, and most precious metals investors have seen the long-term chart of silver, which looks like a massive cup and handle. And so does gold, by the way, if you look at it in adjusted for inflation. I think that we're headed much higher than most believe. And it's happening at a time when sentiment continues to be very negative. We have all the macro drivers to die for in a precious metals bull market. And at the same time, we're seeing a lot of investors losing their focus and talking about how cryptocurrencies are going to replace gold and silver. You can't replace a metal with something that is not even tangible. And so I think there is a lot of big developments happening even in the sentiment space of the precious metals industry, along with this capex decline that has been already a problem for so many years, hitting at a moment of the pandemic's issues too. So I think silver is headed much higher than where it is right now. I think, as I said, the important level is 26. When we close above that on the quarterly candle, there is really not a lot of resistance all the way to 36. And then at 36, we start seeing some resistance. We may see another pullback during that period. And then after that, I think we're headed to new all-time highs. I think that's where silver sort of that roadmap, in my opinion, is going to play out in the following months or maybe a year or so.
How about the same outlook for gold, Tavi?
Look, gold is a little more. It doesn't move as much as silver, but it's also very bullish. I mean, we saw gold trying to take new highs, and it did technically, but it really needed a pullback to go significantly higher from now. I can definitely see gold trading well higher than 2,000s in dollars an ounce in the next 12 months or so, and I think that's going to have major. Right now we're seeing this kind of a significant increase in metal prices, but not huge. But we're seeing massive improvements in fundamentals of the mining space. So imagine if we do see gold prices trading at, let's say, 2,500 or so. Which I think is very likely to happen. So, especially given this, the level of monetary and fiscal stimulus and those three trends that I was referring to from demand, supply, and policy side. So, I think I don't have a lot of technical levels that I'm watching for gold. I think silver is much more of a bigger focus for me personally, but I think gold is headed much higher, especially when there's sort of a moving target that you can use, which is the central bank's assets. If you aggregate the largest central banks in the world, you look at their assets and you compare that with gold, actually follows each other very closely throughout history. And recently, it's clearly suggesting that gold prices could be at about $3,000 an ounce in the next few years. And so I think there's some crazy estimates for gold prices out there. I hope they're all right. But personally, I think I'm a little bit more conservative, but I think it's still a $3,000 an ounce gold price is a very large change in the mining space, as all of you know.
So some analysts say that the miners typically lead the metals prices higher. Do you share this view? And could we have started this next leg up, Tavi?
I do. In fact, I published a chart recently of that gold to the mining space, GDX or GDXJ, especially GDX. The seniors are starting to lead the way here. Yesterday, we saw gold prices decline, but GDXJ was up. And so the juniors and the miners, and since the pullback that we've had in August, if you look at a lot of the more early discovery companies in the precious metal space, you see clearly as well that they have not pulled back as much as the average company in the industry. And so I find that important because as you become constructive in metal prices, gold and silver, you start seeing investors beginning to go up on the risk curve and look for investments such as the mining space. And so it's much more sticky than what we've seen in the past, where I see investors starting to buy into on the value or growth perspective of this industry. And it starts from the top. It starts from especially the larger miners, the Newmonts and Barricks of the world, the royalty companies. All of those have been doing especially better than gold. If you look at a ratio of the GDX as an example relative to gold, it's been outperforming and breaking a trend line that is very important recently too. I think that for so many years we've had, especially precious metals rising, but not so much with the miners. The miners haven't done as well, especially recently. I think that there is a chance where that's about to change. When you look at a long-term chart of the XAU index or the Philadelphia index for gold and silver companies relative to gold, that there is also a major resistance that we're hitting there. Once we break that, which I think we're very close to it, I think it's going to be an inflection point for that industry too. I think we're about to see that in the following months or so.
Do you have any rules that you use to construct your portfolio in the metals, Tavi? Something like taking a barbell approach to mitigating risk by having senior producers alongside drill stories?
Not so much. I think that the biggest diversifying aspect of our portfolio positioning is geographically, but mostly is internally what we have in terms of conviction of those companies and allowing the winners to run and increasing in size as they begin to work. And so I think the biggest mistake we've done in the past in terms of asset allocation, it was rebalancing too much a lot of our portfolio and not allowing those winners to really perform as they should. And so cutting those gains and so forth. And I think that it's something we've changed a lot in terms of our portfolio positioning recently, is allowing those companies to grow exponentially if they do in terms of weights. And so we have geographically focused in different parts of the world, such as the Golden Triangle. We've got a lot of positions there. We have a lot of positions in Newfoundland. We have a lot of positions in Nevada, a significant exposure in some parts of South America, such as Brazil, Bolivia, even a little higher in Mexico. We avoid places such as Africa, and we have a significant exposure in Australia too, and Finland. So, we have about 60 companies in our portfolio today. And our goal really is to not so much, given our views about where we are in terms of a secular bull market for gold and silver, we wanted to be at the very early stages of the industry. So when you look at the whole industry, there's the larger miners, the developers, and also the early discovery companies. That's really where we are in the exploration space right now, as we think that there is really a supply problem, not only happening in the overall economy, but inside of this mining space, where the depletion of reserves and large producers in general will be looking for new deposits to replace and increase their pipeline of growth of production going forward. And so they will be looking for very high quality projects worldwide. So we like to look for strong names that we view that geologically make sense in terms of an investment. We try to be aligned and take an activist approach. And so we've had, as I said, about 60 companies in our portfolio today, and we're very, very committed to those names as of now.
Tavi, you were mentioning this depletion of reserves, and you have, or you recently published the gold supply cliff chart, which I find very, very dramatic and very striking. So how important is it to have exploration dollars coming back into this industry?
Well, that's a good point, because the supply cliff issue is really happening for a lot of reasons. One is the capex that has been diverging from metal prices, where capex is actually not growing. And a large part of that is also related to exploration budget that has been not increasing at all. And the third part is the geological challenge of finding gold and silver in different parts of the world that used to be a lot easier back in the days. And so you have all those forces going against the search for new deposits. And, I think it is an important part of our thesis, because the other part as well is how cashed up those larger companies are. So if you have a high quality project today, Newfound Gold being one, will be shopped around. Will be shopped around by the larger majors. Has a high probability of being acquired by the larger majors in the following years. And so unless they are looking to doing their own production and taking their own developments into advancements in the following years, that is another option too. So it's incredible to see at a time when this green agenda is really having an impact on the creation of new mines worldwide. It may get even worse. Everyone is excited to go from the old economy to the new economy when they forget how to get there. To get to the new economy, we need commodities. You can't just get innovation, the innovation curve to be as steep as it is without commodities following that trend. So I have a feeling a lot of folks are not really focused on copper discoveries, gold discoveries, silver discoveries, platinum discoveries, and so forth. And that's going to become an issue. So I think that the depletion of reserves in the larger producers will more and more, become a problem and an attention for a lot of those producers that have not really improved as much as they have in the past in terms of of new discoveries. And so we've had no new discoveries, large new discoveries of gold in the last 3 years. And I'm talking about over 2 million ounces of gold. And that is basically the case in almost every commodity outside of oil. And so this is all going to become a problem in my view. And therefore, why we want to be in the very early stages of the industry, where the discoveries and the exploration companies that are doing a great job at really trying to find gold and silver and other minerals and metals in those properties, and trying to take more of the district view about a place rather than just one or two companies. Really trying to consolidate some of those regions. We've had, if you look at our portfolio today and how many active drills we have in the companies that we're involved with, it's more than the three majors combined in the gold and silver space. And that goes to show how much of money is being spent on exploration. So I think this whole industry is poised to, especially the early stages companies, to do very well, and people that are able to navigate the space and do research and find the best companies, the winners in the early discovery places, are really the ones that are probably going to benefit from this. And so Crescat is trying to take a strong approach there, and hopefully, I think we've proven very well so far that we can do very well in the space. But I think there's a lot more to do here.
Excellent, Tavi. Do you have anything you'd like to leave our listeners with as we wrap up here?
Sure. I think that there's I would like to reemphasize the problems that we're seeing worldwide with the supply disruptions that are happening, that are much more permanent than what we saw in the past, along with this. Again, the scarcity of labor that may become a problem. I think that's the next part of the thesis of the roadmap of the 1919 Spanish flu, which there were a lot of uniqueness to that period of time, especially coming out of the World War I. However, I do find a lot of similarities, especially with what's happening in the commodities space. In terms of underinvestments in this sector of the economy globally. And so I think that those are the most important parts. And don't forget, there's also the political environment that we have in place with the democratic leadership, along with Janet Yellen back as in the government with leadership, and a Federal Reserve that is calling all this transitory. So I think there's a lot to really think about. But in terms of positioning, I have never been so bullish in terms of the tangible assets, especially commodities and monetary metals, especially. And silver, for me, as I said before, it is the cheapest metal on earth. It's something I own personally in the funds. And for me, what's the biggest leverage that you get in being in such an environment is through buying companies that actually have gold and silver in the ground. So that's where I'm very excited, and where I think the next opportunity is for the following years.
Excellent, Tavi. You put out a lot of work on your Twitter, a lot of excellent charts, as well as your guys' quarterly research letters. Those are available at crescat.net, and also you follow you at Tavi Costa on Twitter. Anywhere else you'd like to point people to, Tavi?
I also started an Instagram account just to test things around, and it's at Tavi Costa Macro. If somebody uses Instagram, I post the same things that post on Twitter there, and in Portuguese too. So if you try to learn Portuguese, that's a good place for you to start.
Excellent, Tavi. Thanks so much for your time today.
Thank you very much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.